So, ladies and gentlemen, welcome. I tell you, for a panel on dark pools, there's way too much light in here. So, too much light is not always a good thing. Welcome to the panel. Welcome to Berlin. 2008, Barack Obama was here. He was a candidate for the presidential election in the United States. And he said, people of the world, look at Berlin, where a wall came down, a continent came together, and history proved that there is no challenge too great for a world that stands as one, except getting exchanges and banks to love one another. So we're going to talk about that today. We're going to talk about dark and transparent trading. We're going to talk about organized trading facilities. We have a great panel. To my right, María Teresa Fábregas, who is an incredibly bright lawyer and economist, and that can be a very potent combination. And if you read MiFID II and MiFIR, you'll see. Senior European civil servant, and I have to say, extraordinarily nice person to work with. To my left, we have Frank Hatheway, who is the power behind Bob Greifeld, chief economist at Nasdaq, and I have to say, very annoyingly, he's also a very likable guy. To his left, we have Marcus Hooper, who is the managing director and principal at Agora Global Consultants. You'll see from Marcus's biography that he spent over 27 years in financial services, which means he must have started when he was about 10. And one of the more interesting things he has written is the sensational $1 million a minute inside the mega money high-tech world of traders. That's definitely a must-read. And then, last but certainly not least, we have Michael Sterzenbach, who is the Secretary General, and I've been trying to pronounce this all day, of the Bundesverband der Wertpapierfirmen, which is the National German Association of Securities Trading Firms and Stockbrokers. So welcome to everybody. I'm going to uncharacteristically stop speaking now and try not to intervene too much. I would like you to be strict, or I will be strict on time. I'm going to give you all 3 minutes to do an opening statement, and then we'll go into discussion. And no matter how passionate the panel is, we're going to leave at least 10, if not 15 minutes for Q&A from the room, with maybe one exception. Maite.
Okay. Thank you, Mark, and thank you, FESE, for the invitation to this event. So my introductory remarks will relate to where we are on the MiFID negotiations and some elements about its content related precisely to transparency and market structure. So as you know, the Irish presidency has done an excellent work and has managed to reach what we call a general approach last Friday on the MiFID, meaning that next week we are ready to start the negotiations between the European Parliament and the Council, the so-called trilogues. This means that if we are very motivated and work hard, which is the intention of the forthcoming presidency, Lithuanian presidency, the Commission and the Parliament, we will be able to reach a political agreement by the end of the year. As you know, the positions of the European Parliament and the Council are similar but divergent on several areas. And areas on which they are divergent are related to market structure, related to transparency, related to non-discriminatory access to CCPs and trading venues, related to third country regimes. These are the key 4 areas. Given the fact that the panel on which we are now deals with the issue of the dark, I'm going to focus then on the transparency elements. And I'm going to focus there because, on these elements because we consider that they are crucial for the MiFID review. They are crucial because with the MiFID review, we want to establish a safer, sounder, more transparent, and more stable and responsible financial system. And this system should allow that the markets, the real economy, gets the necessary finance. So to finance the real economy, this should be the real purpose of the financial markets. We need, therefore, financial markets that are fair, transparent, efficient, and liquid. We mean by this that fair means that the best price should be accessible to all market participants, and the latter should be protected from abusive behavior. In terms of transparency, we mean that information on orders and executed transactions should be made publicly available in order to reduce information asymmetries. efficient because the price formation process should reflect the fundamental value of the traded instruments and lead to an allocation of capital that best serves the economy, and liquid because market participants should be able to sell and buy assets within a reasonable time frame in a safe and orderly manner with minimum market impact. And this is the reason why the Commission is behind the promotion of transparency both in the equities and non-equities markets. In this regard, in the text concerning equities, the text from the Parliament and the Council differ. In the Council, there are volume caps that do not exist in the Parliament text. In the Parliament text, the price reference, the reference price waiver remains together with a large in scale. Therefore, it means that there will be a good negotiation concerning transparency, but always from the Commission side with the goal of improving transparency. Then I shift to market structure, because when we talk about dark pools, it's not only the issue of transparency, of application of the waivers, but it's also the issue of platforms that exist today that, according to MiFID I, can be outside the MiFID framework, and we want to capture them. As you know, the Commission proposal on OTFs wanted to have a legal framework that would capture all types of existing unregulated multilateral trading venues in order to regulate them. And this is the reason why we propose that this new type of venue, the OTF, should cover all types of financial instruments, because for us, similar trading practices should be governed by similar rules and subject to strict transparency requirements. And these are characteristics that will apply to the three venues. Here, on the Parliament side, the text has reduced the scope of the OTF category to non-equities. On the Council side, the text is for equities, non-equities, but it includes specific provisions for the non-equities. In terms of, for instance, for illiquid sovereign bonds, it allows for proprietary trading. That for the Commission was a red line because we wanted to make a clear distinction between multilateral trading and bilateral trading. And for some non-equities, not being the derivatives eligible for centrally clearing or for the trading obligation, it allows for match principal trading. So again, here we'll have important discussions between the European Parliament, the Council, and the Commission. And here also is extremely important to say that the objective of the Commission is to incentivize trading in regulated venues and in transparent venues. That's why we have linked the transparency requirements to the financial instruments, not to the specific platform on where the instruments are traded. I would like also to highlight the fact that in the Council text, there is a trading obligation for equities, meaning that they should be traded in the three venues or systematic internalizers. In the Parliament text, instead of that, we have an OTC definition. Again, the goal is the same, and it's the original goal pursued by the Commission. Therefore, I think that in terms of objectives, there is an alignment, but what needs to be discussed is precisely what are the detailed technical solutions in order to achieve that.
Thank you, Maite. Frank, tell us what's wrong with dark pools? Why dark pools not good for investors, in your view?
Happy to, Mark, and I think the short answer is everything and nothing. So now I've proved I'm an economist on the one hand and on the other hand. The dark pool environment in the United States is probably more evolved than it is in Europe at this stage, and most of my remarks are going to be based on the experience in the U.S. and an analysis of the U.S. market, so I'm going to take a minute on background for how the U.S. is structured and organized. In 1999, broker-operated multilateral trading facilities were exempted from registering as an exchange. At that time, as Seth Marin said, the systems that fell into this category either handled institutional-sized blocks or they were things that were very akin to what you would consider a multilateral trading facility. They were essentially transparent, they were accessible, and they offered non-discretionary executions. You sent an order, you hit a quote, you got a trade. We also had, in addition to these exempted entities, we had a substantial amount of internalization that took place in a dark environment, and we had other OTC activity that took place in the dark environment. Collectively, to me, these are all dark pools. In 2007, jumping ahead 8 years, these types of entities were about 15% of the market in the United States. They bounced off 40% of the market earlier this year, hovering around 35 right now. Gone from the number of single broker operated entities that essentially fall into this exempt category but serve multiple clients. Once again, that Seth was talking about has gone from essentially nothing to over 30. That has been the largest single growth area. They've gone from, again, essentially nothing to about 15% of the market. If that's the end of the story, we're simply talking about how the trading space gets divided up, and that's a competitive issue, and it's not particularly interesting to anyone except those of us who have the competitive threat. But it's not the end of the story. So let's spend a minute on how the dark pool sales pitch works at a very simplistic level. Come to my dark pool, and you'll do at least as well as the prices you see in the lit markets, and you may do better. And a person who gets asked is the person who has the most attractive order flow, the order flow where you have the highest probability of trading it better than the lit prices and not regretting it later on. What then happens to the lit prices? Well, the lit prices are set by two types of entities. They're set by limit orders coming from investors, and they're set by market professionals, market makers, whatever you want to call them, specialists in the old days. The investors are going to set their limit prices either based on multiples of 5 or 10, for some strange reason I don't quite understand, or they're going to set their limit prices based on what they see set by other investors, the professional community. So the professional community, the professional liquidity providing community becomes very important in terms of how the price gets set. They set a price in such a way that on average they make money. I mean, it's a business. If you take away from this mix of what goes into the lit markets, exchanges, NPFs, whatever it is, the people who are the easiest, safest, most profitable to trade with, you change that average. You change the nature of the average investor. That has an effect on what the professional community does. Spreads get thinner, they get more brittle, they get wider. Once that happens, you can go to another class of investors and say, hey, you can do at least as well in my dark pool as you can do on an exchange, and the cycle continues. So what do you wind up with? First, at this point, this has been a theoretical argument, I think one that many of you are quite familiar with. It's more than that. We've done studies of the U.S., other people have done studies of the U.S., there have been studies recently done on Australia that essentially say spreads widen out. There's evidence of that. Darker a stock happens to be relative to similarly situated stocks, wider the spread's going to be. The more volatile the price is going to be, the worse market quality is going to be. When the Australians made the regulatory change that Seth referred to, 2 of the 3 studies they cited were on the U.S. market. The third was on the Australian market. What about everything and nothing? It depends. Well, what does it depend on? Well, one of the other things we've done in our analysis, and other people have done as well, is we've looked at blocks. There are no blocks anymore, so we've looked at the top 1% of trades. The top 1% of trades, if you break those out separately from everything else, don't seem to have a negative impact on market quality. Other people have looked at blocks, have found the same thing. I haven't looked at midpoint executions in our analysis yet, but I have a feeling midpoint executions are going to look a lot like blocks. Why? Because there's really no professional market maker getting in a midpoint. You think about a dark pool, and a dark pool needing to trade on the spread or very close to it. Well, that means there's a professional liquidity provider in there. Somebody who needs the spread as an incentive to trade, not somebody who's just looking to source liquidity. On the sort of non-empirical side of what's wrong with dark pools, we heard Martin, I'm not even going to try. We heard Martin on the previous panel talking about transparency issues. Let's think about transparency, what it really means. It's not just seeing the quote in the last sale. That's what we've gotten used to in an exchange environment. Transparency is really about verifying what happened to my money. It's about what happened to my money when I do a trade. It's about how the company I've invested in is governed. It's about how the company I've invested in is performing. Once you have a sizable amount of trading that's taking place where you really don't know how the system works, you can't verify how your order was handled, who chose to interact with it, who chose not to interact with it, you lose some of that transparency. You lose some of that ability to verify. And as Martin was saying, you lose some knowledge about who owns whose shares. The other significant issue is, as Hans Ole was saying in his keynote this morning, the impact on small and medium-sized enterprises. From this fragmentation of liquidity, the loss of accessible liquidity, we've done a very recent analysis on small biotechs in the U.S., 250 companies, and they're small. The ones with higher levels of dark trading have less liquidity, significantly wider spreads, significantly lower levels of institutional ownership. Now, I'm fine with dealer markets. Nasdaq was a dealer market for most of its history. But those are transparent dealer markets. Those are accessible dealer markets. Dark dealer markets are a different animal and seem to have a particularly negative impact on smaller companies. So to recap, what's the harm? Market quality gets worse. The higher level of dark trading you have, that's an empirical fact. There are concerns about transparency and about really what transparency means, not what's a proxy for it, trades in quotes, but verifying what's happening to my stock, my trade, my money. And finally, the negative impact on small and medium enterprises where liquidity is so critical and now it's hard to find. Thank you.
Michael, thanks, Frank. Michael, MiFID I, broke down those evil stock exchange monopolies like Euronext, introduced major fragmentation across the market, and arguably double the non-transparent trading. From your perspective and the perspective of your members, have they benefited from MiFID I, and what's their experience of the non-transparent stuff now?
Well, Mark, thank you first of all as well, and thank you to FESE to letting me participate in this very interesting discussion on this panel here. Our association is representing small and mid-sized financial institutions, market specialists and market makers and trading houses in Germany, which despite they are small and mid-sized companies, they are completely wholesale in their business. So they were, with respect, you asked me how MiFID I did affect us. Well, first of all, the breakdown of the concentration rule was not a big issue for us at all since we were used to fragmentation. We have, as you know, for a long history, a multiple number of stock exchanges and securities exchanges in Germany. So competition among them was just our normal lot for a very, very long time. But of course, MiFID I had an impact on the business of our members, in particular on their function as market makers or at this time market specialists, or as they were called, Skontroführers on exchange. For instance, the business or the market model did change significantly, as you will remember. Among one of the key categories for determining best execution for retail investors was surprisingly the speed of the execution. So while we had before MiFID on most of the German exchanges a market model which was, well, more or less it was a hybrid model already, but it was still very strongly a model which based on a continuous auction principle. With the introduction of the speed as the key factor, or one of two key factors among the overall price of best execution, our market models did change, and today we have more or less still hybrid, more market maker driven market models as a reaction, because the order of the retail investor needs to be filled immediately, otherwise the order goes somewhere else. This is just one impact MiFID I had. Another one was, of course, it did add to the overall regulatory burden, and since regulation creates cost, this is very much with no profit associated directly on the other side. So this is very much a question of fixed cost distribution, and of course it is more difficult for a small company to distribute fixed costs than for a larger company. So we did see, for instance, a number of mergers about our member firms in the years following the introduction of MiFID I. Well, there are other effects, but I would like to stop here. I would like to thank Frank very much for giving his introduction to the economic basis about what we would like to talk about here today, and the very important observation and conclusion of the loop, the backward loop between the dark pool trading on OTFs and the reference market. So once there is an extraction of liquidity from the reference market, it's not a comparison between a ceteris paribus situation, but the dark pool, the extraction of liquidity changes the situation on the market with giving it the reference price. And the other important thing is, I mean, the objection, the aims of the MiFID recast, as Maria Teresa did put it, to have safer, sounder, more transparent and more efficient markets. I mean, it is very hard to object any of these. I mean, transparency maybe is not an aim in itself, but it contributes to the three other factors. If this is the aim, and if we can very easily agree on this is something very achievable, but the problem is as often in the detail. And the problem we have with the categorization of the OTF category is the question, does an OTF operator trades all customers equal or not? And with the difference between an MTF and an OTF, that an OTF has a flexibility in terms of discretionary execution of orders. I mean, if you read it, what can this mean? Well, it means obviously that you can treat customer A differently from customer B. So otherwise there is no discretion. But we can talk about this later.
Exactly.
Because this leads to a number of interesting questions.
Exactly. Thank you, Michael. And we will come on to the topic of OTF and we'll come back to you. I mean, you said that transparency is perhaps not a name in itself. I would argue that, 5 years after the financial crisis, where some would say the global investment banks brought us to the brink and led to this crisis, that transparency should be a name in itself. Michel Barnier has said that nobody has yet demonstrated to him why a lack of transparency is justifiable in financial markets. Marcus, I'm going to turn to you. I mean, when the investment banks are not busy doing the Lord's work, one would argue that they, like everybody else, deserve a profit, and that there is a direct correlation between the level of transparency in the trade of a financial instrument and the level of profitability. Dark pools exist in order to make cash. What's your perspective?
I'm not going to disagree with that. The people that are participating in these kinds of mechanisms are absolutely trying to make cash. There's no question about that. The question is the motivation by which they're doing it and the purpose they serve to the general marketplace. Just occasionally through the course of MiFID and MiFID II, we've heard the word utility raised. It's a fascinating word. I think it's a very important word. I think markets should have some element of utility. And there is a problem here because we get into some very tricky semantic arguments, things like fairness. Now, I remember in the original drafting of MiFID I, the word fair and words fair and fairness cropped up quite frequently. You don't hear them so much anymore because that is just such a loaded issue. It's impossible to disentangle. I think what I'd like to just touch on, though, and Frank's already made a very good point of this, is that the terminology dark pools is incredibly confusing, and it's largely, I think, misused. Dark pools now seem to include multiple things. They include internalized flow that, in my opinion, is multilateral, not bilateral, in broking environments. It includes the kinds of platforms that Seth Merriam was talking about earlier, block trading platforms, and lots of other behaviors as well. Now, when I think of the argument you're talking about for why should there be no transparency in some situations, I'm not going to defend it, I'm just going to tell you why some people want it. So why do people want it? Well, institutional investors very often suffer enormous transactional costs and market impact costs simply because the market becomes aware of what they're doing. And the market's a very efficient animal. The market becomes aware of what those people are doing very, very effectively. So their appetite for avoiding that information leakage, you can appreciate, is enormously high. The question, therefore, is that reasonable for them to want to avoid that transparency? And here's where, as I say, we get into reasonableness and fairness, and that's a challenge. We do obviously touch into areas like market efficiency. So, for example, Frank's already touched on the point of market spreads. Our market spreads, in fact, a proxy for market efficiency. I'm not an economist. I've been a trader for a long time in the past. I don't think spreads are any real indicator of market efficiency. I've not felt that ever. I'm yet to see any evidence to prove to me that that is the case, in fact. And even if you take the opposite argument and say, well, let's have spreads that are substantially wider, bear in mind how the markets work nowadays. Even as a retail investor, I am not forced to execute at the spread on the wrong side. I don't have to buy at the offer. I am perfectly entitled to submit a bid and put it in as a market limit order. So I can actually benefit from a wide spread if I'm a clever trader. There is no reason why I'm forced to do that. So that whole structure is a little different than it was 15, 20 years ago. I do also think that market structure as a whole is a big issue here, because when we think about the SME markets and we think about small cap stocks listed on exchanges, they do trade incredibly differently. Why don't we see high frequency trading in small and mid cap stocks? Well, it's because they don't trade frequently. That's the nature of those trades. They just don't execute in the same way. And there are more efficient mechanisms for getting those stocks traded. And very often that is slower and more patient, and often in larger quantities, rather than this consistent, very, very small micro slicing that we see in the large cap stocks. But really, I think the reason we're in the situation we are at the moment with this confusion over dark pools and the regulation that should surround them, I'm a bit of a skeptic. I tend to think that MiFID I was actually quite cleverly drafted, and I think it should have captured, in fact, a lot of the issues that we're debating today. And I'm going to stop in a second, but I would say that the whole context that OTC trading in equities is some mysterious thing that was not recognised, I find very difficult to believe. And the reason I find that difficult to believe is if you are, let's take London as an example. If you're trading on the London market, to be an OTC transaction, you have to trade off exchange. To trade off exchange means a variety of things, including that me as an asset manager, I have to tell my broker I am willing to give up all the protections of the London Stock Exchange, including surveillance. And I can assure you that asset managers do not accept that.
Thank you very much, Marcus. That's the last point I think we want to come back to. So, Maria Teresa, I mean, we've got the justification for the large and scale waiver, that block trades do have market impact, and there's a justification for them to take place away from the lit market. But surely the European Commission should even be doing more to minimize the exceptions to the rule. We have the negotiated price waiver. We've seen the discussions in Council over caps on the reference price waiver, which arguably shouldn't even exist, since the only solid justification or exception is large in scale.
Well, I'm very glad that you present this point now this way, because actually, as you know, when the Commission presented the proposal, our intention was to improve transparency, but we thought that it was going to be done at what we call the level 2, no? Because the waivers today exist at the level 2 legislation. Then the discussions in the Council and in the Parliament brought the transparency discussion at the level 1 level, which now we consider is the right level to discuss. And it's precisely what the Commission is saying now, that we consider that only the large-scale waiver is justified. We consider that the other waivers, what they do many times is just also blurring this function between brokers, venues. So what has been said about the fact that if there is a lot of trading, the percentage of trading in the dark is very high, this blurs completely the price formation mechanism. So the price formation in the lit market will not be the price that should be. So we are very worried about these issues, and as I said in my preliminary statements, let's say, one of our key objectives for the trilogues, and Mr. Ferber is already here, is to improve transparency, and not only in the equities, also in the non-equities area, because even if the MiFID I had no rules about pre-trade transparency in the non-equities, we consider that the markets now are very important at big, and we had previous presentations that were telling us that fixed income now is a big, has a huge volume, and therefore we consider that it's very important also to fix the transparency rules in that area and to fix them at the right level, not to allow loopholes, because at the end of the day, with all these waivers, what we create sometimes is incentives to trade in the dark, and that's the opposite of what should be done. And we have seen that both in the text of the Parliament and the Council, there are movements in the right direction, but we from the Commission side would like to go a bit beyond that.
Now, Frank, you know, obviously we argue for the exchange's perspective on this, and it's perhaps somewhat self-serving. I mean, investors want choice in execution venue, and they want choice in the style of execution. It's critical for them. Is it not true that the exchanges, such as Nasdaq, have slavishly followed the public limit order book model, which doesn't really cater for the needs of these institutional investors?
I don't know if we've slavishly followed it or been constrained to following it, but you think to what an exchange model was like 29 years ago when I got into this business, and I was 6. I was a runner on the floor. There was a crowd, and somebody would come into the crowd, and you had a pretty good idea who they represented. The client didn't come into the crowd. The broker wouldn't tell you who the client was, but you knew who that broker usually represented. And you would then set price, set quantity, consistent to what you expected from that broker. In Europe and in the US, that model has been progressively pushed aside and replaced by a deterministic electronic limit order book. I pre-commit to trade with all comers. Whoever comes in, I trade with them. That may well make a great deal of sense in compliance. It may well sound fair, to Marcus's point. It may well be a dominated style of trading, that if you can trade in any other modality, you will use that modality before I unequivocally commit to trading with all comers. So the electronic limit order book model, although it brings efficiencies, and although when they were first introduced, before people could adapt trading styles and essentially still went to the exchange and operated with the exchange the way it was structured at that point in time, may, in the fullness of time, either require, as was discussed in one of the earlier panels this morning, the ability to segment perhaps in a deterministic algorithmic way approved by regulators, so it's fair, but again, it's giving different prices to different types of participants or different quantities to different types of participants. Or it will essentially be a dominated style of trading, and we will see the spiral that's started in the United States continuing. And the first time I raised that issue was 2009. Dark trading wasn't as high as it is today. And it was at a congressional Senate hearing, and the response at the time was, well, it's new, we don't really know what's happening with it. And secondly, this may be steady state, so why worry about it? Well, it's 10 percentage points later. The reactions from the regulatory community, our client community, the buy-side community is now somewhat different than it was 4 years ago. It's more along the lines of, well, let's discuss how the markets are organized, how they're structured, where they're heading, and whether this is really what we want.
Of course, arguably, the buy-side still cannot be heard at the political level because they're forced to keep quiet by the sell side, often same parts of the same financial institution. Michael, you heard Marcus describe dark trading in London really as kind of bungee jumping with a safety net. You know, if you accept to trade in the dark, you lose all guarantees, all protections, all insurance. Your market makers in Germany, are they more likely to use the lit venues, the dark venues, and what are the primary reason for the decisions?
Well, we have, as mentioned before, we have different markets and we have different market structures, but they all are relatively similar. So they offer some kind of continuous auction with market maker support systems, which are in terms of transparency, some kind of hybrid systems according to the MiFID, to the current MiFID classification. And I think it is important to mention that there's nothing wrong with, I mean, first of all, I agree with Marcus that the determination or the wording to say dark pool is very confusing. We have different market models and we have different forms of pre-trade transparency which is appropriate and which is necessary for different segments of the market where we have different levels of liquidity. I mean, the predominant open limit fully electronic order book market is a very efficient way of trading liquid instruments. Mm-hmm. But it looks completely different when you getting to more illiquid segments of the markets. And then these are the segments, as Marcus also mentioned before, are those which are representing small and medium-sized issuers. So the part of the economy we really want to support and to promote. And from the capital, from the secondary market side, you definitely need some kind of liquidity support functionality, some kind of market-making functionality. And you also have to give investors different choices of market models. So we absolutely don't object that investors have choices among different market models among which they can choose. And of course, we also should ask, if we are looking at the dark pools or internalizing systems in London, why they did become so relatively successful. I mean, there's a process in the other markets which, for which reason, never did make it for certain investors attractive to follow the promises of the operators of the dark pools, of the so-called dark pools. And this would be fine if the conditions of competition and the quality of price formation would be the same. But we are concerned about that under the current proposal with the discretionary execution of orders. This is not the case. And this is the point where we're concerned about, no matter what kind of name the baby has.
Right. Well, again, we will come to OTF in 1 second. Maybe a final question on the transparency side to Marcus. The Council, in its infinite wisdom, has elected to retain the reference price waiver, albeit with a cap. And the cap, as you know, is 4% per venue and 8% for the total volume across Europe. In your view, what would be the impact of such a limit?
Well, the impact is you're going to hit a boundary at some point and it's all going to go horribly wrong. That's the problem. And again, my direct experience of block matching in a dark pool type environment is that it happens most effectively in the strangest places. So if you look at the very, very small cap stocks, it is perfectly normal for a day's volume to be 30, 40, 50% executed in the dark by a block. It's not unusual for those volumes on those particular days to be many, many multiples of the average daily volume, because all of a sudden, by fluke, magic, circumstance, the right buyers and sellers come together at the right point in time and they're willing to trade huge, huge sizes. So I think setting any threshold is fundamentally problematic in that way of setting a threshold. Mm-hmm. However, when it comes down to the specific waivers, be it reference price, be it large in scale, I would fully support large in scale as a waiver. I think that has some reasonableness about it. Now, you could argue, of course, that yes, that does remove transparency from the market. But then again, if you execute a very, very large block that is printed to the market very quickly, I would argue there's an element of transparency emerging from that very action. I would say that large trade has now informed the market of the right level for a large volume of transactions going through. Yes, you could argue that a retail investor may not have participated. Again, we get into that whole semantic argument about fairness. But it is definitely a challenging thing when you start thinking about the smaller dark orders. And I stopped short earlier when I was speaking of saying where I fall on the fence on the small orders. I can't see a justification for a very small order executing in a dark manner away from the lit market. I mean, to me, it doesn't make a lot of sense. I don't quite get it. I could speculate there are nefarious reasons why that might occur, but I certainly don't see that the mechanism is missing for that transaction. And once again, I don't believe it's because it's bilateral, because investment banks do not operate bilateral systems. That's not what they do. They operate vast databases of orders.
Okay, you stumped me on the last one, but we will, I'm sure, discuss that when we open this up to the audience. María Teresa, is it true that the Commission has introduced the OTF category because nobody in the banks could spell systemic internalization? No, but seriously,
this is not, this
joking,
is not the reason.
Joking aside, I mean, joking aside, we used to have one fabulous stock exchange per country, and in the good old days. Now we have over 150 venues in the European Union in which we can trade stocks. Do we need more fragmentation? Do we need another category?
Well, the reality is that today there are platforms outside there that are not regulated under MiFID, but they exist. And they exist because under MiFID I, one of the definitions for MTFs was partial, and therefore it allowed for the development of these other platforms outside that definition. That's the reason why what we intend, as I have mentioned, is to introduce a future-proof definition of what is a multilateral platform in order to make sure that it is not possible to have multilateral platform outside the three ones that are in the regulation: regulated markets, MTFs, and OTFs. And what I was saying at the beginning about the fact that for the OTF category, the same organizational rules apply, the same transparency rules apply. They cannot discriminate against clients because they have to have non-discriminatory requirements and objective criteria for their members. The pre-trade transparency obligation applies, therefore, pre-trade, we know what it means, pre-trade, that there is someone that matches the order, so that's what it is. Best execution applies, therefore it's very well framed what is the OTF, and there is no margin for privileging or giving privilege to some clients or other, and not to others within the OTF. When we are talking about discretion, this discretion enters into the game because the operator of the OTF is an investment firm that has to fulfill best execution rules, and therefore it comes into the fact of whether the order is when the order is introduced in the system, if there is no best execution, can be withdrawn and can be sent to another platform or internalized. So this is the intention, and I can say that why do they exist, these platforms in the dark today, these broker crossing networks? I said because of the regulation, the way it goes, but another reason that has been given to us is because the players in those multilateral platforms do not want to be confronted to high-frequency trading. So this is a key issue that today it has been slightly mentioned only, but it's very important to regulate high-frequency trading. The Parliament has introduced additional amendments and requirements to the Commission, also in the Council text. And yes, so there are several reasons why we have the OTF. And for non-equities, of course, we have the G20 commitment that we want to fulfill through this category.
For derivatives,
yeah.
Sure. Frank, let's say for the sake of argument that Marcus Ferber and his colleagues in the Parliament don't win on every single issue. I mean, they probably will. But if they don't win on OTFs, should Nasdaq set up an OTF? Should NYSE set up an OTF?
It's the sort of thing we have talked about and debated in the past. We are constrained in the States where the problem is more severe from doing it. We will accept whatever trading structure we have to operate under. And in that structure, we'll set up a corporate entity, and we'll set up the trading system that does what it needs to do to compete. As I said, we route to dark pools. We're not great fans of dark pools, but the demands of our customers for a router that can go anywhere have us routing to dark pools. At one time, we sent out indications of interest. After complaining in a setting like this in the United States, we thought indications of interest from exchanges were horrible ideas. Please ban them. There was no ban. We did it. 2 months later, we took them away. We still don't do them. But we essentially made a point that they're a bad idea for exchanges. So would we set up an OTF? We would try really hard not to because it's inconsistent with our principles. And if we operated one as we operate a dark pool today, it would operate ideally consistent with our principles. So the Nordic at mid is a midpoint dark pool. And that type of dark pool we think is consistent with satisfying the displayed market first and essentially having liquidity-driven traders, not trading profit-driven traders, have the opportunity to meet with each other. So whether right now Nasdaq at mid sits inside a regulated market, if it made sense to put one in an OTF, we would probably put it in an OTF.
Okay. Marcus, Michael, before we open up to the floor, any comments on OTFs?
Well, I guess my comment would be, given a choice, you would choose OTF rather than MTF. I mean, why would you want the overhead of an MTF if you could possibly avoid it? You know, principles aside, Frank, I respect principles, but most people aren't going to follow that route. I just think the whole thing is rather problematic. As I say, I struggle to even understand how we've ended up in a situation where OTFs are really under consideration, because voice broke trades in equities do not occur anymore. Let's be clear about this. You may send an electronic transaction, which is then followed up with a phone call occasionally, but that's as far as it goes. These are fully automated electronic platforms. They're totally systematized. There's no discretion in them. There's no point pretending there is. The point at which discretion occurs is when a human being gets involved, and they do not get involved at that level on the micro transaction. So I think we get into a lot of complex semantic issues.
Very good points. Michael?
Yes, I would say, or as Maria Teresa did put it, I mean, the objective is for the discretion rule that an investment firm which is obliged to fulfill best execution for its clients to be at the same time the operator of an OTF, as I did understand it. If this is the purpose of this rule, then I would be less concerned if it really works this way, if you make it waterproof this way, if you can indeed avoid that the provisionary flexibility is not used, that an OTF operator can promise de facto one client to be treated more favorably than another client only because he brings large quantities of order flow or whatever. If this can be made waterproof, then our concerns would be much less. Nevertheless, we still think that from a systemic point of view, the category itself makes MiFID more complex and a little bit more confusing. From a logical point of view, I think there is bilateral trading and there is multilateral trading, and we already have this covered with the SI definition and with the MTF or regulated market definition, and it would be only necessary to include a provision that those operators of multilateral system which are at the same time obliged to fulfill best execution obligations, for my taste, this could have done in a less confusing and leaner way.
Thank you, Michael. Ladies and gentlemen, I'm going to open this up to the floor now. It's time to get controversial, unless there's no requests. Any questions for the panel? I'm surprised. Either you're all convinced. Here we go. We all know each other, but for the benefit of everybody else, if you can say who you are and who you represent. Thanks. We've got a mic, Carlos.
Yes. It's okay?
Yep.
Maria Teresa told us that one of the aims of the Commission was to capture all the multilateral activity that was not being properly covered by the legislation. Wouldn't have it being simpler to introduce a definition, a clear-cut definition of OTC, and give the treatment of multilateral to the rest of the activity? And when I say the clear-cut definition of OTC, based on the standard criteria, bilateral, large-scale, professional investors, and the like, why to add more complexity to the landscape, introducing one extra trading venue type in a context of fragmentation? Why not to introduce a definition of OTC?
So the Parliament's text has a definition of OTC. The Council went a different way with the trading mandate. Why is the Commission not in favor of a definition of OTC?
Well, the definition of OTC, for instance, the way it has been presented, can be very broad. And when we define OTC, it means that all that trading is out of any type of rule. Pre-trade rules, transparency rules are not applied, only the post-trade would be applied. So we consider that it's more dangerous than to do the trading obligation and to be able to oblige that trading to happen in the multilateral venues and in the systematic internalizer. To introduce only an OTC definition without the OTF category would not be helpful either, because, as I said, with the text of the MiFID I, the BCNs have been able to be created because the way it was drafted. And what we would not like to do is to dilute the definition of MTFs. We would not like to dilute the definition of MTFs in order to capture also these other type of platforms.
Thank you. Any other questions, ladies and gentlemen? I see none. Marcus.
Would you mind if I just pick up on this definition of OTC? Because I think, again, there is also a potential problem with defining OTC. Most people would think of OTC as transactions occurring on an irregular or infrequent basis, and I'm just merely highlighting some potential unintended consequences. If you look at large-in-scale block matching systems, I don't know if you're particularly familiar with the actual hit rate of those systems. 1% execution rate is very good. Now, if you want to think about irregular, that's incredibly irregular.
Thank you very much. I'm afraid we're going to have to bring it to an end. Ladies and gentlemen, we have arguably the second most important German politician in the room, so we're going to leave the floor to him. I want to first of all thank my panel, María Teresa Fábregas from the European Commission, Michael Sterzenbach from the BWF, Frank Hatheway from Nasdaq OMX, and Marcus Huber from Agora. Thank you very much. Thanks for listening.